Hi, everyone, and welcome. Thank you for tuning in to today's webinar on Nacha Operating Rule updates for banks and credit unions. My name is Nancy Patton, and I work within the Marketing and Communications Department here at Saltmarsh, and I'll be your moderator today. We're glad to have you here, and we're going to be bringing you some more industry-specific webinars in the months ahead, covering everything from compliance issues like fraud, fair lending, CRA, to developments in tech and cybersecurity. As you know, Saltmarsh has a team that focuses entirely on serving community banks and credit unions, and we look forward to bringing their expertise to you through these webinars to share the latest information. If you're interested, you can sign up for email updates as new programs are offered, and you can find webinar recaps, upcoming events, and related info on our blog and website. Leading today's presentation, we have Janice Weisz. Janice is a senior consultant in our financial institution advisory practice. She has been working with banks and credit unions since 2001. And you could say that she's our Nacha expert. She frequently writes for our blog on the topic and provides ACH compliance, Nacha compliance, and internal audit and other consulting services for our firm. Just before we begin, I have some few housekeeping notes to go over. Everyone on the line has been muted for privacy. If you have questions, you're welcome to share them with us in the questions feature of your GoToWebinar's control. If we have time at the end of the webinar, we'll go over your questions, and if we don't have time, we'll follow up with you directly. You can also share questions in an email to the bank advisors at saltmarshcpa.com. The webinar is being recorded, and you'll receive it tomorrow along with a copy of the slide deck in an email. And finally, upon leaving, you'll be prompted to complete a very short survey. We'd love to hear your feedback and what you thought about today's presentation, and also any ideas for upcoming webinars, like topics you'd like for us to cover. Janice, I'm going to kick it over to you.
Thank you, Nancy. So hi, everybody. Thank you. Good afternoon. Thanks so much for attending this webinar. I greatly appreciate it. I hope we are all looking forward to maybe a 3-day weekend, if not a 4-day weekend, if you get to take Memorial Day off. Thank you, Nancy, for introducing me. I do want to say a couple of things. I know I kind of looked at the list of registrants that were attending this webinar, and I saw obviously there's going to be a lot of this webinar. These are anybody and everybody's welcome to attend the webinar. So the more the merrier, as they say. There are a lot of clients that I audit that are attending, and there are some people that I met when I did a presentation out in Tennessee, the Tennessee Bankers Association last year. So I'm glad that some of y'all were able to attend as well. And then, but like I said, well, anybody and everybody's welcome. So thank you all for attending. But my name is Janice, as Nancy said. I've been with Saltmarsh for since 2008. When I first started with Saltmarsh, I did a lot of different kinds of audits, external audits, internal audits, trust audits, a bunch of different stuff. But so somehow I ended up doing ACH reviews, and I actually just kind of fell in love with it. So I started doing more and more of them. I really, since probably 2012, I've solely been doing ACH reviews. I got my ACH accreditation, and now I do ACH audits for financial institutions, both banks and credit unions, and I do third-party service provider, Nacha compliance audits, and sender audits. So I really like it. I found my passion, so I'm happy to be here, and I'm happy that y'all are attending. So this is the disclaimer that I'm sure are on most slide decks, where obviously this is for educational purposes. I am not a lawyer, and this is just my interpretation of the rules that I'm going to be addressing today. I also have a Janice disclaimer. My Janice disclaimer is I'm not really used to presenting, so I might get a little nervous, but the way I'm planning on approaching this is I'm used to talking to my clients when I do audits in this fashion, and I always address recent and upcoming rules with the clients so that they know what's coming down the pipe and how it may or may affect them as an institution or as a client in general. So I'm just going to pretend I'm doing that. So hopefully I won't get too nervous. Disclaimer number 2, I can kind of talk fast sometimes. So I'm going to try not to do that. So if I get going too fast, and hopefully I'll catch myself, I apologize up front, but I'm going to try to not get to go too fast. So that's the disclaimers. Now we're going to get on to the next slide. The first thing I just kind of want to say are some commonly used abbreviations, because I know I'm going to be using these throughout this presentation. Obviously, I'm going to be talking about Nacha, which is the National Automated Clearinghouse Association. They manage the development, administration of the ACH network. So they are abbreviated as Nacha. And you'll see that Nacha is a capital N and a lowercase ACHA. For years and years and years, they've referred to themselves in Nacha as all caps. But now if you look at their website, now it's Nacha with a capital N ACHA, just food for thought. But they did change it, I think last year sometime they changed it like that. So that is not a typo, that is how they refer to themselves now. So Nacha has implemented, and every year they issue a current version of the Nacha Operating Rules. So this is how it looks this year. This is the 2021 version of the Nacha Operating Rules. Every year they issue this set, and then every year they change the cover of the book. So you can kind of go, yeah, so yellow, bright yellow is 2021. Last year I think was a more teal color, something like that. But every year that's how they kind of differentiate them, is by the colors of the book. I will say this is my favorite because yellow is my favorite color, and yes, I like it this bright. So that's Nacha Operating Rules, and like I said, they issue a new set every single year, and that's because they obviously have rules changes every year, so they go ahead and implement, issue out a new book. The next few, so Nacha Operating Rules is commonly referred to as the rules or Nacha Rules. The next one is a participating depository financial institution, commonly referred to as participating DFI. Receiving depository financial institution is an RDFI. Originating depository financial institution is ODFI. Third-party service provider is a TPSP, and a third-party sender is TPS. Now, a quick summary of those last participants is a participating depository financial institution is an institution, a financial institution that participates in the ACH network. So even if you're only a receiving institution, you post entries to customers, your receivers' accounts, you're a participating DFI. A receiving depository financial institution, you may only act, you have the right to only act as an RDFI and not as an ODFI. But a receiving institution is when you're responsible for posting transactions to your receivers' accounts as required by the rules. And then if you're not able to post certain entries and they reject for some reason, then you're required to return them in accordance to the rules. And that's your main responsibilities as an RDFI. Now, as an ODFI, not every institution has to be an ODFI, but an ODFI would be if you're originating entries into the ACH network, either on your own behalf for like loan payments or on behalf of other corporate originators that you've onboarded. A third-party service provider is an organization that performs some type of function on behalf of another entity. So what's famous for banks, the banking industry, for third-party service providers would be like Fiserv, Jack Henry, CSI, Sinestra. Those are all service providers that are providing some type of function for you as a financial institution. So that would be a TPSB. Now, a third-party sender is an entity that is processing payments on behalf of another entity. So, for example, and it's where the agreements lie. So this is a good example where a third-party sender could be a payroll company that has an ODFI origination agreement with the under ODFI, and they're processing payments on behalf of other companies, but the ODFI doesn't have an origination agreement with each of those companies. That would make that payroll company a third-party sender because they're processing payments on behalf of other businesses that don't have an origination agreement with that ODFI. So that makes sense. So that's a summary of commonly used abbreviations that I'll be discussing today. So this next one is, this is going to be our topics, the recent and upcoming rules that I'll be addressing today. So we're going to be addressing 6 of them. We'll get into on the left-hand side, obviously, are the effective dates, and then the rule itself is abbreviated on the right. So obviously, we're just going to get right into this. The first rule that we're going to talk about is supplementing fraud detection standards for web debits, also known as the account validation rule. So just keep in mind, this is a high-level overview of these rules. So I'm not gonna, I won't get totally in the weeds with it, but I will be trying to address, I think, the key factors. If you do have any questions, obviously pose those. If you need to contact me after the webinar is done, my contact information will be at the end of the slides as well. So this first rule is going to apply to web debit originators. So that could be a financial institution that's originating web debits on their own behalf for like loan payments. It could be a third-party sender that's originating web debits on behalf of other businesses. It's a web debit originator period, like a power company. And it's a very commonly used, or even a third-party service provider that's doing web debit on behalf of other originators. So it's a very commonly used web SEC code. So a web debit is when it's supposed to be used, and that's web is the standard entry class type code. That's what type of payment it is. But it's to be used when a business is debiting a consumer account when the authorization is taking place either over the internet or through an unsecured wireless network, like a mobile device. So that's when it's supposed to be used. Again, it applies to all the parties that would be originating a web. So there's no thresholds. If you originate one web entry, it applies to you. So it's not like based on how many you're doing. So under the existing rules, so this does go into effect March 19th. So this is kind of prior to March 19th. The existing rules, the way they read, is that you are required to use a commercially reasonable fraudulent transaction detection system to screen web debits for fraud. That rule's been in effect since the beginning of web debit, since it started. This new rule is doing is enhancing that already existing rule to explicitly require that account validation must be performed as part of that commercially reasonable fraudulent transaction detection system. So now they're enhancing it where you have to do account validation. I will say even before this went into effect, when they initiated the rule in the first place, they did in their rules, they didn't require you to do account validation, but in the guidelines, they already had recommended it. But now, because there's been a lot of fraud over the last few years, they're trying to combat the fraud by making account validation part of that commercially reasonable standard. This rule does go into effect March 19th, or did go into effect March 19th, 2021. However, as long as you're working in a good faith effort towards compliance, so you're not just sitting on your hands, not going to enforce the rule for an additional period of a year. So enforcement of the rule will become effective March 19th, 2022. And enforcement means if you're not compliant by then you could be susceptible to rules violations and fines being incurred. Not saying they're going to come zeroing in on you, but if they saw that some activities seem to be fraud and there's no kind of account validation as an ODFI, they could go and enforce some rules violations in that area. So this is some of the requirements. So what this means is all web debit originators are going to be required to validate the account number that is being the account number. So that means you got to verify that the account is legitimate, it's open, and that ACH entries can be posted by the RDFI to that account. So it does not mean that you have to perform account valid ownership. You don't have to verify that the name matches the account. So if it's my account that's going to have a web debit against, you have to verify my account number, but you don't have to verify that my name is tied to that authorization. Now, again, because it being a commercially reasonable standard, you have to know what type of industry you're in. So if you're in an industry that every 99 companies out of 100 are verifying the ownership on the account, they're verifying the name does match that account number. If you're in that kind of industry, then yes, you do need to you can't be the one company that doesn't, because that won't hold up in court. You would have to commercially be a reasonable standard, and that industry could be that you have to do account ownership, but the Nacha rules do not require it. You just have to know what your industry would require as commercially reasonable. This rule it is applied on a going forward basis, and any account number that's already been used is grandfathered in. And that would make total sense because, say, for example, you're going to implement your account validation on, say, June 1st of this year. So if you've already processed the transaction, it's already gone through the ACH network, you've already been being paid through that account number, then it's already been validated. So you don't need to validate it come June 1st, it's already happened. So those are grandfathered in. So this is applying to the first time the account is being used for that ACH payment, and then you must validate the account first. So that could be the first time a customer is making a payment, or it could be when a customer changes the account number that's being used for the online payment. So that, for example, if you're an originator and you use TEL, which is a telephone transaction to authorize a payment, and say you use paper transactions so they can authorize through paper, which is a PPD, or you could, or you do web. So you say you offer all three of these types of payment applications. If, say, I'm the customer and I go to make my power bill, if I usually call and I make my pay my power bill over the phone, well, that would be a telephone transaction. But they've already validated my account number because I do this every month. I call them. And so your account number has been validated through the TEL process. Well, now I don't want to call them anymore. It just takes too long. Nobody answers the phone, whatever it is. Then you go, if you want to go and do it through their online portal, then you go online. And if I want to make my payment there, then that would go through a web. So if you're able to, if your system's sophisticated enough where you can already verify that they have already validated my account through TEL, then if it's the first time I'm using it through web, but you've already validated it through TEL, then you don't have to validate it again. It's been validated. But you have to have the mechanism to be able to determine that. If you don't have a way to see that that's the same account number used as a TEL that's now being used as a web, then you still have to validate it. So that's one way that if you've already done it, then you don't have to validate it again. But otherwise, you would have to validate it the first time you're trying to do a payment. Now, there's different ways to do that, and that's here. So the account validation, these are just some of the methods that you could perform the account validation. The Nacha rules are neutral as to how you do it. They're not going to tell you what method you got to use and what technology you have to use to validate. It's going to be up to you on what best works for you. So these are the commonly used ones that I'm most familiar with. ACH pre-notification entry and ACH microtransaction verification are already commonly used, and maybe not always for web, but just to verify accounts in general. An ACH pre-notification is when the originator is sending a $0 entry to the RDFI that it contains the account number, the account name, the TRAN code, so that means what account type it's going to be posting to, so that's a checking or a savings, and but it's $0. It has no pennies involved. It's just $0. It's just really providing information. This is where I want to post a transaction. So if it's a good account number, then it just automatically goes through the receiving institution system, and they don't have to do anything because they don't have to let you know it's not a good account number. So then the originator has to wait for at least 3 days, and if they don't hear anything back from the RDFI, so they don't get any communication back on regarding that entry, then they're good to go with processing the live dollar entry. So that, but they have to wait 3 banking days to do that. So if the ACH pre-notification doesn't go through because, say, the account number is wrong, the account number is closed, the account's closed, something like that, it's going to reject on the receiving institution side, then they are required that when they get a rejected pre-notification to either initiate a return or to initiate a notification of change. So a return, if they return it, then that's just going to return it saying, hey, this account was closed, or this account number was unable to locate, it's not a good account number, something like that. So when they send the return back to the ODFI, which forwards that to the originator. The originator would then have to look at it to see if they made a typo or something went wrong on how it was entered in the system and see if they can correct it. If not, then they have to get with the receiver, especially if it's account closed. They're going to have to get with their customer to find out what happened. And then they're going to have to potentially send another pre-note to figure out, now, is this the right account number? If they get a notification of change, however, the RDFI that receives is not required to initiate a notification of change to the ODFI, because when they initiate a notification of change, it's going to tell the ODFI and the originator ultimately what was wrong. So say it comes through an account number, they just transpose 2 digits. It hits the reject report on the receiving institution side. They look at it and they're able to determine, yeah, they just transpose numbers, and they're comfortable going ahead and sending a notification of change back to let the originator know what they need to do to change it. An RDFI is not required to do that because they're warranted that that information is correct. So if they make a mistake, it's on them. So the ODFI, once they get it and they pass it to the originator, they can feel comfortable going ahead and making that change, because if something goes wrong and they did what the RDFI instructed them to do, then the RDFI could be on the hook for that. So I know a lot of banks that don't even initiate NOCs on the rejected pre-note side because of that. It's not affecting their account, so they just return it. But I mean, that's up to the banks, the institution's practices. But so once the NOC is received, though, then the originator can make the change and go ahead and send the live dollar entry, because now they've made the change, they're good to go. So that's kind of the pre-note process. It can take up, like I said, up to 3 days for it to happen. So it's not real fast, but that is one option. The other option is an ACH microtransaction verification, which again is commonly used. Those usually are sent by the originator. It's got like pennies attached. It could be like 23 cents or something like that. They send that to the RDFI. The RDFI posts it to the customer's account if it's a good account. Then the customer actually has to go log into something or through email or somehow verify with the originator that that is, yes, this is me, and this, I did do this, and this is, or this is the correct account. So then once that happens and that process goes through, then they can turn around and send the live dollar entry. That also can take some time because you have to go through with the process, and then you have to actually wait usually for the customer to validate it. The last one is probably the fastest, but obviously commercially available validation service, it's a service you have to pay for. So there's a lot of different services out there that have popped up and probably have been existing for a long time, but definitely are making themselves known right now because of this rule, that they can, I'm not familiar with these, but you know, like firsthand experience, I just have taken training and have heard about how they work. But you pay for the service, and then when you're entering in that account information, when it's going through the system, it has, you know, the technology where it can determine like a percentage. It's 99% sure that this is a good account number. So it's looking for anomalies and just different stuff. So that's how the validation, I mean, all of them work a little bit different, but that's one of the ways I've heard they are working. If you're more interested on that part, I know Nacha on their website has some of them listed where you can, you know, look up on, and probably look up the names there. In addition, you could probably just Google account validation for web debits, and then I'm sure several would pop up. But like I said, I don't have any firsthand experience on it, how exactly any of those actual vendors. Now, what I'm also going to do as part of this presentation is at the end, when I'm done talking about each of these rules, I'm going to try to say how I feel they could impact you as a ACH participant. So this is the last slide for that. So that's what I'm about to hear or talk about. So the impact to participants, ODFIs, number one, they should be educating. If they have any web debit originators, you should be educating them. You should be already talking to them, finding out what they're going to do in order to be compliant with this rule if they're not already compliant. So say the web debit originator tells you what they're going to do, and they're in compliance. They're saying they're going to, you know, do it. Y'all as an ODFI warrant that your originator is compliant with this. So, you know, you want to do as much due diligence as you can to figure out that they are doing what they're supposed to be doing. If you're really just going by their word of mouth, then things to watch for are returns. If you get a bunch of returns that are associated with web debit origination that are account closed, able to locate account, invalid account structure, those are key indicators that maybe their account validation isn't working. Not saying that 100% of them have to be validated. That's not what they're saying is commercially reasonable. But if you're getting a bunch of them, several, and I don't know what a bunch is, y'all as their ODFI should be able to determine what a bunch would be. But you should definitely be monitoring that, because if you're getting a lot, I know during my audits, I would be looking for that. I won't be auditing your originator, but I would be auditing you as an ODFI, and since you're responsible for your originators, I'm going to look at, that's what I'm going to look at. I'm going to look at your returns and see if you have a bunch of those types of returns where it looks like that their account validation process is not working. If you see it, then you need to reach out to that web originator and talk to them and see what's going on. Another one key return that you need to look out for is R17, and that's that one that is optional for a receiving institution to use. So it, but if you get it, it could be that there could be fraud going on the account. And R17 has two uses on the return. One is a file record edit criteria, which is something's wrong with the file. So the other one that would be associated with this is the return is if the entries with an invalid account number initiated under questionable circumstances. That's the return reason. So if you receive R17, there should be, if it's a questionable circumstance, it should be questionable listed in the addenda of the return. If you get those, I would really escalate it immediately to your originator and see what's going on, because that means their RDFI thinks there's something going on with this originator. So, and they can see a lot if they got a whole bunch of returns or a whole bunch of entries posting and they don't name match, they don't all these different things, and they could think that they're fishing for account numbers or something. So you should escalate that. Originators of web debit entries, well, obviously y'all need to get in compliance. If you're not already compliant with this, then you need to figure out and talk with your vendors and whoever, your team, and just see what you're going to be able to do to get on board with this requirement. If you're not sure what you need to do, then obviously you can also reach out to your ODFI. I mean, your ODFI is responsible for you, so they I would hope would already be communicating this to you, but if not, they should be able to tell you what to expect, what they expect out of you. As far as RDFIs, receiving institutions, there is no additional burden to you regarding this rule. However, because of this rule coming down the pipe, then, or happening, it's already there, but y'all could receive a greater number of rejected or pre-notification verification. So essentially you could receive a greater number of rejected pre-notes that you have to work during your non-post processing, and potentially a greater number of rejected micro-transaction verification, micro-deposit transactions. Also, if you plan to use the R17 code, and I'm an advocate of that code, but you have to know if your system is capable of putting questionable in that addenda field, because it's really a good thing to let that originator know that y'all think something's questionable going on. They should take corrective action. I'm not saying they all do, but they should if they see those. But I do work with a lot of financial institutions that don't have that capability to put questionable in that addenda record. If that's the case, you really can't use that code, because then the originator will not know how to differentiate whether it's a questionable transaction or it's just a field edit criteria problem. So if you're going to use that code, make sure your staff that is going to be using that code knows how to use that code and when to use it. So that's it for the web debits. That's probably one of the longer ones. I think we have one other rule that's going to be a little bit long. But the second one that we're going to talk about is a quick one. I only have one slide for this. This was a rule that went into effect in 2 different phases. It's called Differentiating Unauthorized Return Reasons Rule. And this particular phase that went into effect April 1st is applicable to the unauthorized entry fee that's applied to the R11 code. So first, I'm going to summarize real quickly about phase 1. Phase 1 did go into effect April 1st, 2020. And I want to say right now, I know not everybody is a client that I audit. I am happy to share what I know with anybody who's willing to listen to me. But if you're not familiar with what I'm about to talk about or what I do talk about, feel free to reach out to me, or because this is a rule that went into effect, and I know the clients that we audit know about it, but I can't say that if everybody would be aware of it. And this is really important to use these return reason codes correctly. But April 1st of 2020, Nacha repurposed 2 return reason codes, and that was R11 and R10. They gave them new return descriptions. And before April 1st, 2020, the R10 return reason code was used for multiple reasons. And these are both, now they're both unauthorized types of return reason codes. So I'm just going to kind of give you an example of how it was used before and how it's supposed to be used now. If a customer comes into the receiving institution and they say something debited to their account and that was not authorized. If they say it was not authorized, or if they say, yeah, I authorized it, but it was debited, I was debited for the wrong amount. I authorized it, but I was debited for the wrong date. I was debited, but I never got my credit. All those used to be returned as R10. That is not the case anymore. Effective April 1st, 2020, they split it to where if the customer were to come in and say, I was debited for something, and I don't know who this is that debited my account, I never authorized them to debit my account, it's still R10. But R11 picks up a lot of the other ones. If they came in and say, yeah, I was authorized, but they debited me for the wrong amount, they debited me for the wrong date, or they debited me, but I never got my subsequent credit, then those are all R11. And it's very important that you use the right return reason codes. So number one, as a receiving institution, you warrant that you will. So you really need to. But it also, it requires the originator to do something differently based on whether they need to get a new authorization on whether it's an R10 or 11, and that's too complicated, so I'm not going to get into all that, but unless you need me to offline. But for these kind of returns, you have to get a written statement of unauthorized debit. So also what happened around April 1st, most of the financial institutions, if they use a written statement of unauthorized debit that they get through a vendor or through their service provider somehow, those written statements, most of them had an update, or you needed to get a new form, because a lot of them reference which return reason code to use based on which box they mark as the reason why it's unauthorized. So you may want to make sure your written statement isn't showing you to use R10 for all these different reasons, because then it's really out of date, and you're going to potentially use the wrong return reason code when you process them. R11 also in April 1st, 2020, it was ODFIs have to monitor return rate categories based on Nacha's ODFI return rate reporting. Again, this is just debits, but that R11 immediately was supposed to be dropped into the unauthorized return rate category and should be being monitored. So all that went into effect April 1st. Now, this in 2020, April 1st, 2021, phase 2. So this just went into effect, where there's a $4.50 fee income that's transferred, where the ODFI gets charged the fee when they receive an unauthorized type return reason code. So that before April 1st, 2021 pertained to R05, 710, R29, and R51. That fee has already been being processed for years, where the ODFI gets charged the fee, the RDFI that processed the return gets the fee, receives fee income, because it takes a little bit more time to process these items. So, but April 1st, 2021, now R11 is also, that fees being processed between the ODFI and the RDFI for the R11 as well. But these returns are very critical that they're handled correctly, because if you're not getting all these require written statements on unauthorized debit to be executed prior to returning them with these return reason codes, you don't want to be perceived with the return using these codes when you should have used, like, say, stop pay, R08, because it could be perceived that you're trying to get fee income for returns you shouldn't be processing that way. So I know I do detailed testing in these areas when I do audits, but just be real mindful that y'all are doing what you need to do with these. But that is that's it for that particular slide. Now I will say, as far as impact to participants, it's really what I just said, that the RDFIs will get fee income. So just make sure you're processing them with the right return reason code, so you aren't getting fee income for returns you shouldn't be processing that way. And for the $4.50 for each one of these return reason codes, are R05, 710, 11, 29, and 51. And then ODFIs are going to be charged that fee for the same ones. So that's it for that. So the next one, this is the other one that's going to be a little long. So supplementing data security requirements, protection of account numbers. So this is a data rule, and it's going to be about protecting account numbers that are being stored electronically while at rest. So first, I want to say Nacha for years has had what they call as ACH Security Framework Rule. And within that rule, there's certain security requirements. So this particular rule is being enhanced to where it's explicitly stating that large non-financial institution originators, third-party service providers, and third-party senders are required to protect account numbers used in the initiation of ACH entries by rendering them unreadable when stored electronically while in an at-rest state. So this says again that it's not including financial institutions, and that's because financial institutions are already subject to rigorous data security requirements imposed by the regulators. That's why they're excluded. But large non-financial originators, third-party service providers, and senders, it all is going to apply to you. And that, like I said, you're supposed to render, well, we'll get into that instead, but you're supposed to render the account information that's being stored electronically as unreadable. So first, we're going to talk about the effective dates, because it does go into effect in 2 different stages. They're going after large volume originators first, the largest volume originators first. And so effective June 30th of this year, this has been a rule that's been coming down the pipe for a few years too. So they keep extending it back a little bit. But so I know I've talked about this a lot with a lot of my clients, but any originator, third-party service provider, or sender that originated 6 million or more transactions, ACH transactions, not dollar amount, it's actual transactions, during the 2019 calendar year must be compliant by June 30th. And that is not a typo. It is based on 2019 numbers. So that's the first phase. They have to be it goes in effect June 30th of this year. The second phase, and the number to watch ultimately forevermore, is going to be the 2 million mark. It's any originator, third-party service provider, or sender that originates 2 million or more of ACH transactions during the 2020 calendar year. So that again is the correct calendar year, must be compliant by June 30th, 2022. Now, Nacha did the same thing with this rule as they did with the web debit, where if, as long as you're working in good faith effort towards compliance, that they have deferred, they will not enforce the rule for an additional year. So like phase one, yes, it's effective June 30th of 2021, but they will not enforce it until June 30th, 2022, as long as you're working in good faith effort towards compliance. And phase two, yes, it's effective June 30th, 2022, but they will not enforce it as long as you're working in good faith effort towards compliance until 2023 of June 30th. So, but the big thing to understand here is it does apply to all standard and entry class type codes. So every payment type that they're originating, and it's based on an aggregate of what they're processing through, if they only use one ODFI or if they use multiple ODFIs. So number one, for example, if you have an originator that's originating PPD payment types, CCD payment types, TEL, and web, then you have to count them all. I mean, what they've originated through 2019 and 2020, all of it, it's an aggregate. You also need to ask them, do they originate through more than one ODFI? If they do, you need to ask them how many they originated during that, through that ODFI, because it's an aggregate, even if they're using multiple ODFIs. So the next slide is actually specific to third-party service providers and senders, where it specifically is saying they must consider the combined volume of entries processed for all of its various clients when determining if it meets the annual 6 million or 2 million threshold. Because it's not client specific, and these types of providers or senders are processing on behalf of more than one client. So you have to combine it all. Third-party service providers and senders that originate and or transmit ACH entries through multiple settlement accounts and or multiple financial institutions should take volume from all ACH entries they originate and or transmit into consideration when determining if they exceed the thresholds. So again, it's combined. You have to look at all of it. So I think we have, this is probably the last slide. No, we got one more thing. This one is telling you what it's going to include. So it applies to any place where an account number related to ACH entries are stored electronically while in an at-rest state. So that includes consumer, non-consumer account numbers. It includes both debits and credits. That also includes paper authorizations. So if they signed it, it's a paper authorization, but you scanned it and you're retaining it electronically. So it's going to apply to that. Does not include authorizations that are maintained in paper format. So if they signed it, but you didn't scan it, then it doesn't apply to that, but you still have to keep it securely. So you should be having it in a locked file cabinet or locked doors or something. But it's not going to matter as far as the rendering the account number unreadable, since it's not being stored electronically. This includes systems on which authorizations are obtained or stored electronically, as well as databases or system platforms that support ACH entries. So these are the ways that you can render it unreadable. Again, these are just some examples. The Nacha rules, once again, are neutral as to how you're going to do it. They don't say exactly what you got to do to render the account information unreadable or the account number unreadable while being stored at rest, but these are some examples. So encryption, truncation, tokenization, and destruction. But I want to say for destruction, if you're going to destroy something, you better be careful, because if you have to, there's certain documentations, like you have to be able to provide evidence of authorization to a requesting ODFI, then if you destroy it, that you can't provide it. So be real careful on what you end up destroying if that's the method you're going to take. Again, these are just some options. Each originator definitely needs it, or third-party sender needs to make your own business decision and consult with legal counsel and your technology providers to see what way would work best for you. The next part is me just discussing some potential impacts to participants. So originators third parties and third-party senders and third-party service providers. Obviously, if you're not already compliant with it, or if you're not quite compliant with this, if you're not already doing this, then you need to work and figure out how you're going to get compliant. If you need to contact your ODFI to get advice from them on how they expect you to be compliant, because again, ODFIs are responsible for their originators and every entry that goes through the network using their routing number, so they should want you to be compliant. This is a big number. I mean, I have a lot of clients that have multiple originators, but none of them are probably the actual originators are originating this volume. And when you think about it, even a 2 million mark, that's over 166,000 plus transactions a month. So that's a lot of transactions, but you still need to know for sure whether or not you have any originators that are doing it. So ODFIs, that's what you need to do, is just make sure you know whether or not you have any originators that this is applicable to. And if it is, you need to educate them and find out how they're going to be compliant with it. You need to monitor it forevermore too. I mean, since it's based on annual activity, so like you could already go in and look at the numbers on your larger volume originators and see what they originated in 2019 and make sure they didn't hit 6 million, and see if they did, then you're gonna have to make sure they understand they got to be compliant, or they, you know, the effective date is June 30th of this year. Then you can look at the 2020 numbers and verify that you don't have any originators that hit 2 million, because that's going to be off the 2020 numbers. And then, but what you need to do going forward is every year you really need to be monitoring how many transactions are going through the ACH network from your originators, and make sure whether or not you have any that are potentially going to get to that mark. I also recommend during the onboarding process, you ask them how many transactions do they plan to originate per month, and then times it by 12 and see if they're going to hit that. If they're doing more than one SEC code, ask them how many they plan to do by each SEC code, times it by 12. Ask them if they already use another ODFI to process entries. They say no, you don't have to worry about that anymore. But even on the onboarding, the annual review process thereafter, you should be looking at what they did last year, and then you still should be asking them again, do they use an ODFI to process any other entries? Because just because they did in last year doesn't mean they haven't onboarded with another ODFI this year. I would think most of the clients that I audit, their originators don't use multiple ODFIs, but you know, I would go ahead and take that step and ask them, since you're responsible for them. RDFIs are not applicable. This doesn't impact RDFIs at all. They don't have to do anything different. So that's it for that one. This next one is limitation on warranty claims rule. This one I kind of think is interesting, but currently and forever, ODFIs minimally warrant. Now, I will say this is one of the first rules that was announced in the 2021 rules book that I was unaware of when I did audits last year. So I know I didn't talk about this to any of my clients when I did the audit because I didn't know about it. So this could be new to some of y'all. The audits that I've already done this year, because part of my audits always talk about upcoming and recent rules changes always. So the ones I've already done this year, I've already talked about it, but I'm going to get more detail with this. But ODFIs warrant a basic warranty that they have. They warrant a lot of stuff, but a basic warranty that they have is that an entry that goes to the ACH network using their routing number is properly authorized, and that the receiver's account number is correct. That's a basic warranty. So, but the current rules don't say how long they have to stand behind that warranty. So, you know, consider it like I promise you this is properly authorized, but how long do you have to stand behind that promise? It doesn't address it. So that's what they're doing. So effective June 30th, 2021, the Nacha rules are going to limit the length of time in which an RDFI will be permitted to make a claim against the ODFI's this authorization warranty. So this is only a warranty regarding the authorization, but it's going to limit that. So that's what we're going to be talking about. So there's two different time frames. Well, so there's two different groupings. There's this consumer account time periods and then non-consumer account time periods. So we're going to talk about the consumer first. So again, this is effective June 30th. They're not pushing it back. This is June 30th effective and implemented. But the consumer account time period is, and I'll make more sense when I give you an example, but this is how it reads. It's 2 years from the settlement date of the entry, and if the transaction has been posted to the customer's account for more than 2 years, then it's the 2 years from that settlement date of that last entry, and then 95 days forward of the first unauthorized entry if, like I said, more than 2 years has lapsed. So I'm going to give you an example. Today, and I've seen this happen, this is because there's no limit on how long they have to stand behind that warranty claim, then, or that warranty, this is what can happen, and I've seen this exact situation happen. So say your customer, you're a receiving institution, your customer comes in and says, oh my gosh, my account's been being debited for a long time, and I just realized, I just saw it, and it's not authorized, and I don't know who this is that's been debiting my account. And they've been debiting me since 2015. So the rules allow you as their RDFI to go to the ODFI and ask them for permission to return it late. So it's beyond that, 60-day time frame that you have, 60 calendar day time frame that you have for returning the entries late. So you ask them permission to return these entries that are beyond that 60 days late, and they say no. Then you say, okay, well, can you provide me evidence of authorization, because my customer is saying they're not authorized, and so now I want you to stand behind that warranty, and I want to see where they're authorized. And then they go and look and they're not authorized, they generally will take them all back. They'll go, oh, never mind. I don't want a rules violation filed against me, so I'll go ahead and accept them all back late. I've seen it happen for 2015 forward. All those returns get sent, that they say, yeah, we'll accept them late. Now, that part is what could change. Now, the effective June 30th, the same, you would still could go by the same, so you could still follow the same process by your customer comes in, and they said they're not authorized. And I'll make it explicit in the state too, when they come in, whatever ones you can grab that are in that 60-day time frame, you go ahead and return them. So they say they're not authorized, you return them R10. So that would be 2 or 3 payments if they're getting paid per month, depending on exactly, if it's like one a month, probably 2 payments. So you return them back as R10. So those have already been recovered. But now you got to figure out, so you go to the ODFI, you ask them permission to return it late, they say no. Then you go, okay, well, can you give me evidence of authorization? And they go, oh, well, I don't have that either, but I'm going to make you file a warranty claim to get what you're owed. So I'm not going to give you all of them. So now you potentially have to go to your lawyer, get your legal team to create a warranty claim, and then you have to figure it out by this time frame. So you go 2 years back, but you're not going to claim the ones you already grabbed when you did the return. So it's not going to include those couple. Then you get the 2 years worth of payments, and you have to go all the way back to the first time it went. So say it started January 1st, 2015. You grab that first one and you go 95 days forward and you grab those transactions, and that's what you can stake a claim against. So that sounds convoluted, but that's how they got it. And they're streamlining it with Reg E. And if I think Nacha's, I don't know if they have it yet, but I had training recently where Nacha said they're trying to create like a tool that you can use to enter the dates in that you need, and it will help you figure this process out. But that's how it is on how you would have to do it. Now, I will say not all, it could be that the ODFI, if it's not unauthorized, if they're truly not authorized, they still may give them all to you. That's why I would still go ahead and go through the same song and dance and go ask for evidence of authorization and, go back and forth with that, because what if they're going to go ahead and just give them to you? I mean, they might, you never know. So, but if they're not going to work with you through the return process, then you're going to have to file a warranty claim against those transactions. So that's what it is for consumers. Non-consumers is a lot easier. It's 1 year from the settlement date. So if they had a transaction that posted today, and they had to go every month from 2015, you can just go 1 year back, and that's what you can do the warranty claim against, is the 1 year. You might have to do a warranty claim on a business account, because those aren't quite as easy to get them to return them through the ACH network like late. A lot of times, I've already known some banks that have had to do this for businesses, but I would still go to them at first and ask them for evidence of authorization. It's just if they don't want to give you authorization, they can actually give you the originator contact information instead, because it's a business, the rules are different. But I've known banks that have contacted the originator, the actual originator, when they get that information, and the originator works with them. So you just have to play the game and see what level you got to take it to. But in the end, again, you may have to get a legal team to do a warranty claim. So that is it for this rule. So the impact to participants is ODFIs and originators. Make sure you know the rules. Make sure you know how this is going to affect you, because if you want to limit the amount that you can be claimed against, then this is your way to do it, effective June 1st or 30th of 2021. RDFIs, just make sure you understand on how to handle it. I mean, you don't want to, tell an ODFI they have to give me all of them. This rule is going to, that's not the case anymore. They just have to give you what the rules say. And technically, your lawyer could look on what state law is, because state law or some, that could be different, where you do have can claim more. But that's where a lawyer would have to get involved. Okay, so the next couple are fast. So we're going to cruise through this pretty quickly now. The reversals rule is easy. They haven't really changed too much with it, but they've seen where the reversals haven't been being done right, so they're changing a little bit. So first, I want to say reversals are when you can do a reversal entry or reversal file when you've done something wrong. Like say your originator inadvertently sent a file out twice, so they only wanted to go once, so you can do a reversal to try to reclaim that duplicate file. Now you're not guaranteed that it's going to work, because you're the one that's supposed to be what goes to the ACH network is supposed to be properly authorized. So if you sent it out twice, that whole second file wasn't authorized. So you're not, guaranteed to get them, for it to work out when you do a reversal, but it can. So you want to try to recoup it, whatever went wrong, you want to undo it when you can. So that's kind of a reversal, a very short scenario of it. But what the rules have done is currently the rules explicitly say when reversals are permitted. But it doesn't explicitly state when they're not permitted. But it's just been understood, if you are permitted to do it, if it doesn't have it on the list, then you should be not permitted to do it. It should be prohibited. But because you're seeing them do it when they shouldn't be doing it, they're not explicitly saying when they can and explicitly saying when they can't. So number one, I'm going to actually hit the bottom of this first, because this is currently when you can do a reversal. And that's when you've done a duplicate file or entry. It was improperly initiated. So you sent it twice, something went wrong, you sent it twice. So something like that. So that's one of them. Another reason why you can do a reversal is that it was processed for the wrong dollar amount, or it was processed to the wrong receiver, or if upon separation, so say I quit where I work, then my employer gave me a check because I maybe wasn't owed the same money, or I was owed a different amount of money, but they forgot to delete my name out of the ACH origination file, so I got paid through ACH and I got my check. So they can do a reversal for the ACH entry that was wrong. So that's what you currently can do it for. Now up on the top here, this is why when you can't, you're prohibited for doing a reversal just because your originator or your third-party sender went bankrupt or stole, took the money and ran, so you can't fund the payment. Y'all are responsible for your originators, ODFIs are, so you can't undo that. It's just done. You're just going to lose the money. You can't do a reversal to do it. And that was hugely done last year off a payroll company that the CEO took the money and ran, and they were trying to bring all these credit back. No, those people were owed their money. You can't do a reversal. Another reason why you can't do reversal, if it's outside the reversal time period for doing it. So you have overall a 5 banking day time frame to do it. So if you do a file or do something wrong, something needs to be reversed, you have 5 banking days to do it from the time of the settlement date of that erroneous file or entry. That's it. You can't do it at day 6 or day 7. You're out of gas. You can't do a reversal. And I see this when I do audits. I've seen reversals done outside the time frame. So now they're explicitly saying you cannot do that. So now they also have said they're expanded one-word reason why you can do a reversal. So now you can also do a reversal come at June 30th of this year is if the effective entry of the date is incorrect. So the effective entry of the date is the date you wish, you hope, and you want your customer to be debited or credited for. So if you entered a date inadvertently and it was a date that was earlier than intended, then you're supposed to debit them, then you can do a reversal. If you did a credit and you dated it later than you intended, then you can do a reversal. So those are the reasons why you will be able to do a reversal come June 30th. Also, they're making explicit, already right now the rules say reversal, and you can see in all caps, has to read just like this, every letter capitalized, has to be disclosed in the company entry description field to let The receiver, no, this is a reversal entry. So they can see that it's going to print on their statement. So they can see that. Well, they're also saying that this is under file formatting of the rule, but the company ID, standard entry class type code, and amount fields must be identical to the original item. That's been understood, but they're, you want it to be the same, but they're making it clear that it has to be the same. So let's see here. Okay, and there's one more thing on reversals. This, I don't know how much it's going to be used, but as an RDFI, the Nacha rules are giving you a return reason code to use if you can see if a reversal's been improperly, an item's been improperly reversed. I don't really know how you're going to know that. So I don't know how often this will be used. And on the consumer side, the consumer has to come in and make a claim against it. So if they come in and say something was improperly reversed, again, I don't know how they're going to know that, then you use the R11 code, and you still have to get a written statement, and you still have that 60 banking days time frame to return it. Now, you working with them as an RDFI might be able to determine it was an improperly reversed entry. Maybe that would do it. But again, the thing I would watch for this or RDFIs is just make sure your written statement or your written statement of unauthorized debit isn't going to change again, because this is kind of a different. I don't know if there's a slot on very many written statements that I've looked at. Again, this is kind of new, so it probably isn't where it gives you an option, improperly reversed item. Honestly, I just don't know if it's going to happen too often. The next one is also you can return an improperly reversed item if they're used for a non-consumer, and you'd have to use the R17 return reason code, and then you have to do it within 2 banking days. And it does actually allow RDFIs to use it without the customer contact. Again, I don't know how exactly that would happen. I can't think of a case use that would be used like that, but you just know that it's there. So as far as impacts to participants, just as ODFIs and third-party senders and service providers, originators, if you're doing reversals, make sure ODFIs, make sure your originators are using reversals correctly. They are aware of these rule requirements. And then as far as originators, third-party senders, and service providers, if you're doing reversals, y'all need to know this rule too and make sure y'all are complying with it. RDFIs, if you plan to use these return reason codes for improperly reversed items, make sure you know how to use them and make sure your written statement is up to date and provide training where you need it. So this is the last rule right here where I think there's only one slide for this one. Nope, maybe there might be 2. ACH Contact Registration. This is the rule that went into effect July 1st, 2020, where all participating DFIs were required to go to Nacha's risk management portal website and register ACH contact information with Nacha regarding their ACH operations and risk management personnel or departments. So that went into effect July 1st. You had until October 30th, 2020 to be compliant on registering. So if you haven't already registered, you need to do so. But they did provide an additional 9-month grace period to register. So that's where phase 2 is coming into effect, because that ends July 30th, 2021. So effective August 1st, 2020, you better be registered no later than July 31st, because that is when Nacha can file rules violations if you're not registered. And that is a class 2 rules violation that can be in an amount up to $100,000 per month until you have registered. So register, it's very important. Make sure you understand how the ACH Contact Registry works, because it's a great tool. And I know I'm running out of time, so I'm hitting it. But if you don't know what I'm talking about, again, my contact information is at the end of this. So make sure you reach out to me and I will direct you on how you can get registered if you haven't done so already. So in closing, I just want to make sure everybody knows the Nacha Operating Rules is always evolving. They are constantly changing the rules, updating the rules. And there's still more to come down the pipe, and I hope to be able to do presentations whenever I can talk about the rules as they're coming down the pipe. And I will say every one of those rules I just talked about, I have done a blog at, and now Nancy's going to talk to you about our blogs.
Yeah, so Janice, as our Nacha expert, she's written so many blogs about all of these rule changes, and you can find all of them and the ones that she covered today specifically on our blog. It's saltmarshcpa.com/blog, and you'll find them under the financial institutions category. While you're on our blog, you can also check out our seminars page and RSVP for our next banking related webinar on June 24th, which is about how you are going to approach your Fedline assessment. And then also on the seminars page, don't forget to save the dates for our Bank Talk event It is August 25th through the 27th, and it is all virtual. It is our 16th annual community banking event, and we have a great lineup of speakers, so it should be a really great time. Anyway, thank you guys for joining us, and contact Janice if you have any questions.
Thank you for participating. Thank you. Have a great Memorial Weekend.
Bye.
Bye.